This is important information about qualified retirement accounts brought to you by SCFSIC.
Aloha and welcome. I'm Stan Cox, Principal Broker and Strategist with SC Finance Strategies and Insurance Consultants. Today we're going to talk a little bit about qualified retirement plans. Is your retirement savings plan tied to the stock market? Do you have more than one retirement savings account? What other strategies might you consider? Qualified retirement plans are given tax-deferred status. That is, you can contribute up to a legally limited amount every year from your income before you're taxed on that amount that you contribute. That doesn't mean that you never have to pay income tax on that money, though. It's just deferred until you start taking money out of the account. Qualified retirement plans are also subject to restrictions. Generally, you aren't allowed to take money out of a qualified plan without paying a 10% penalty on top of the tax due on it, unless you're 59 and a half or older. Also, you're required to take at least a minimum distribution from the plan at age 70 and a half, whether you want to or not, or else the IRS will come and take 10% of your monies right out of your plan as a penalty to you. I'm not an investment advisor or a CFP, Certified Financial Planner. I don't have a securities license, so I don't sell investment products. And I don't act as a fund manager. But I do have some knowledge, and I will pass on some information for your consideration here. I'm going to read to you from an article, an excerpt from an article that was published in Money Magazine, which includes some advice from a certified financial planner. Quoting, regarding your 401k, most people want a sizable nest egg, and to achieve this, they contribute the yearly max to their 401k. However, this is a long-standing retirement tip you should carefully consider. Instead, a CFP with a financial solutions group suggested only contributing up to the maximum that your employer matches. Now, I'm going to repeat that. You should consider only contributing up to the maximum that your employer matches. That's free money, and it makes little sense to leave it on the table, he said. However, every dollar invested in tax-deferred vehicles like 401ks, IRAs, etc., creates a large tax liability that comes due during retirement. Get the free money from an employer match, but carefully consider the tax consequences of contributing above that level. Additionally, you might have other savings goals you need to achieve before maxing out your 401k. For example, if you don't have emergency money, you might want to prioritize creating an emergency fund before contributing the maximum to your retirement account. Now, that's the end of the quote from the article. Regarding the deferred tax, right now, believe it or not, income tax is among the lowest it's been for decades. But most everyone agrees that it will, without doubt, increase in the very near future. And guess what? In that future, when you want to take money out for your retirement, that's when you're going to be taxed on that money, and at the higher rate that will be in effect at the time that you take the money out. And that may not be such a wonderful thing. In addition to the tax implications, even as your tax is deferred and you're putting money into the account, unless all the money you contribute is going into municipal bonds or T-bills, all the money in your account is at risk of being lost to market corrections and downturns. Just look at the market history. It happens all the time. There's usually about an 8-year cycle that the market follows. But again, it can happen at any time. The last bull market lasted a good deal longer than 8 years. But what have we seen happen with the market this year, 2020? A whole lot of losses. So yes, free money is good, but you want to be careful about how much of your retirement savings you put at risk of loss. So it makes good sense to start with a more conservative and safe savings plan that you don't have to worry about losing money in. In another video, we will compare qualified investment plans such as 401ks, 503bs, TSPs, IRAs, and so on. But for now, we're going to compare those qualified plans to a well-designed tax-free cash growth warehouse account. But for now, we're just going to propose that you might want to consider building an emergency and retirement savings within a whole life living account that will also provide financial security for your loved ones in the event of your death. Some other advantages these accounts offer that make them so attractive are they are liquid assets. There are no penalties for leveraging the cash values, and you can access the cash value without being taxed on it. In fact, you can access and or leverage the cash value for tax-free retirement income. One of the greatest advantages of these accounts is that they grow with compounding interest tax-free. And when properly designed, your cash value continues to grow even while you leverage it to finance things. That feature allows you to earn interest on money that you spend, earn interest on money that you pay to the IRS for income tax, earn interest or capital gains in 2 places or more at the same time with the same money. If this sounds interesting to you, you'll want to have a look at some other videos here on this channel. Please do. And please subscribe to this channel and post a comment or question here. And for the whole story on the tax-free cash growth warehouse strategy, watch our free on-demand webinar, Become Master of Your Financial World, at the link below in the description box. In that webinar, you will learn why the strategy is so valuable and how you can get started with your own tax-free cash growth warehouse. We're here to help. We look forward to helping you. Mahalo for watching, and aloha.